In this trend overview lesson, we're going to walk you through how trends work, develop, and the cycles they can run in. Think of a trend like a force, such as a river or an ocean pushing in a specific direction as the current flows. Is it easier to go with or against the current? That's the question we want to ask ourselves when looking at a chart. And the answer is fairly obvious. Going with the trend or the current will go farther, faster, and with less effort. Going against the trend or the current, that can be a problem, and in trading, it can cost you. Combining supply, demand, and the trend is the key to low risk, high reward, and high probability opportunities. The OTA, core-based strategy, combines supply and demand, which tell you where to buy and sell, with market trends, which tell you when to buy and sell. The definition of a trend is that a trend tells us which direction to expect the market to go. This will increase the probability of us making more probable trades by telling us the right and wrong times to buy or sell, and it is always in our best interest to trade with the trend and not against it. Trend refers to the direction price is currently moving in and is likely to continue moving in. Trend is also one of our odds enhancers. Trend can be defined as an uptrend, a downtrend, and a sideways trend. Now, historically, market cycles run in 4 stages, progressing through each one of the 3 trends. Now, if you look at the example at the bottom of the screen, the first stage on the left within the diagram begins with a sideways trend where price stays relatively within the same range of highs and lows, and traders are both buying long and selling short in the sideways trend, or they're potentially waiting for price to break out into either an uptrend or a downtrend. As the market starts to move, it heads into the second stage per the illustration, which is an uptrend. An uptrend is made up of higher lows and higher highs, with the trading bias to buy long. From there, price tends to move into another period of sideways trending before the fourth stage begins, which is the downtrend. The downtrend is made up of lower highs and lower lows, with the trading bias to sell short. Afterward, it usually moves back into another sideways trend. The sideways trends are very much the same within the market cycle. The only difference is the direction they move into or out of, either into an uptrend or into a downtrend, or out of an uptrend or out of a downtrend. Now, an uptrend or a downtrend following a sideways trend can tell us whether the sideways trend was an institutional accumulation phase, meaning institutions were accumulating or buying shares, or it can tell us whether the sideways trend was a distribution phase, meaning institutions were distributing or selling shares. A trend is a series of impulsions and corrections connected together between reversals. Notice in the illustration in the green area, price continues to move higher with small pullbacks to the downside. And the same is true for the downtrend. Looking at the red area, we see very strong moves downward with very little and minor pullbacks to the upside. These are the characteristics of trends and the pieces which assist in successful trading. Now you have a basic understanding of trends and the 4 stages a market cycles through. Trends are key in determining which direction to take trades, whether we go long or whether we go short. In future lessons, we'll learn the components of a trend, how to identify trends on a chart, and the strategy associated in each trend environment. Before you move on, review the 4 stages of trend analysis and the corresponding action for each stage, whether it be to buy long or whether to sell short. Hope to see you in the next video.